Hello, everyone. Welcome. It is the pre-show for Coffee and Real Estate Live Chat. Let me just do the usual here and check and see where we're at, just to make sure everything is working. Yep. Let me make sure the audio's going. Yeah. Sweet. Okay. We're up on YouTube. We are... It says the event will start soon on LinkedIn, but maybe it doesn't start showing it until the actual time. I had this similar problem, I think, last time we checked on LinkedIn. So we'll just go by LinkedIn here for a minute, and then we'll check on Twitter. The link never works on Twitter. And there we go. We are up on Twitter. Check on Twitter. Yeah, excellent. Okay. And then, of course, I can see it on Facebook. Facebook's right there, front and center. Hey, welcome to it, everybody. This is the pre-show for Coffee and Real Estate for December of 2023, the last Coffee and Real Estate of the year. We've got some very interesting data to hit. We've also got an interesting pivot on the part of the Fed as it relates to interest rates. So we're going to do a little reading between the lines on that one and see where it might be going. Fannie Mae has officially pretty much put out there that they expect a recession next year. So a lot of things are in the air. A lot of balls are in the air relating to the real estate market. We'll see what's going on with our local stuff. We'll do that sort of 10,000 yard view that we always do, 10,000 foot view from above. Take a look at the county and the largest city in the county, which is San Jose. And then we'll roll it down from there. We'll then hit Morgan Hill and Gilroy, just so that we're sort of drilling down, right? We're starting with the heart of the county and then sort of drilling right back down. And that way it gives us a good perspective, right? We get some really big numbers in the county numbers that can give us broad strokes. And because the data size is so much bigger, it's a more reliable thing to evaluate. In terms of other things that aren't, specifically real estate related, I always encourage folks in the last couple of months of the year to kind of take time out, take stock of what's been worked well for you. What were your goals in January of 2023 that you have achieved today? And what are goals that you didn't achieve? And why didn't that happen, right? What are some things you can do in your life to adjust? And there's no reason to beat yourself up if you haven't achieved some of those goals that you were shooting for. It just means you need to change your strategy, right? And hit that wall again. One of my goals for a long time, for years, has been to lose some weight, right? I mean, I'm still a big guy, but this year I've lost 65 pounds, so I'm very happy about that. I'm about halfway there, so I actually lost a lot more than my goal for this year. My goal for this year was 50 pounds, and I did 65 pounds, so I'm very happy with that. And I'm going to continue with that. I had a few moments of weakness. Thanksgiving was a big one, where we had... because I'm doing the sort of keto thing, right? So no carbs. So I decided I'm not going to do stuffing, just too much carbs and stuffing. So then what did I do? I made a metric ton of mashed potatoes, which proceeded to last for a week worth of other cooking things. So, but once I worked through that particular menu sin, things went back on track. I gained about 7 pounds, and then I lost it all within a couple of weeks. Or no, it didn't take that long. It took about a week. But it's always a good time to reassess. What are the things that are most valuable to you in your life? Are you sort of nurturing those things in your life that are the most valuable? Are you giving them the attention you need? Big milestone in my household in December of 2023. I now no longer have any children in college. As of yesterday, my third son finished college yesterday. and he has his computer science degree. So if any of you out there are looking for a freshly minted computer scientist to start writing code for you, let me know. I'm reaching out, and he's reaching out to find that position. He's going to take the rest of the year off, which is only a couple of weeks, but he's ready to jump in the saddle and get going as soon as the new year starts off. So if anyone's got any leads on good jobs for a computer scientist, let me know. What else? Any other big stuff? No, that was, and you know what? That's pretty major. I mean, to be a parent of 3 sons and then have all of them graduating. The oldest son took the LSAT, that's the law school admissions test, and he's now applying to law school. So he's going to, he's hoping to stay a local boy. At first, he had visions of going to the East Coast and going to some pretty big name schools, and decided he wanted to go here. So he's focusing on Stanford and Santa Clara University. And he likes Stanford University because they're ranked really highly in what he's interested in IP law. So they ranked really high there. So that's where he's likely going to go. Of course, we call it Coffee and Real Estate for a reason. It's 10 a.m. on a Saturday. So of course, coffee has to premiere. I usually like to share with you the blend I'm sporting for the day, but today I'm doing Starbucks. I didn't have any milk in the house. I went out this morning. I was up before the sun this morning. I want to do some drive-bys on some freshly listed properties in Gilroy and Morgan Hill. And I've got more to see in this afternoon. I'm going to be driving over to San Jose and then over to Los Gatos. A lot of stuff to do today. But while I was out, after I finished that up, I stopped at the store and grabbed the stuff I'm going to need to make my coffee tomorrow, but didn't have time to really make my own before the show. So here I am, drinking Starbucks. And I'm happy to say I'm now to the point where my version of a mocha is now better than Starbucks. And even Peet's. I think I have finally graduated to that point where I'm making a better mocha than they are. So now it's a step down for me to go to Starbucks. And even Peet's. Peet's is usually pretty good too. It's just past 9:50. We're going to get started at 10 a.m. and hit the data. And we've got some interesting stuff. We've got a new screen I'm going to start using for the national stuff because I like it. The National Association of Realtors, Realtor.com, has made some changes to some of the way they present data, and I like it. It's really easy to see. It's graphical, so many of us are visual, and it'll be a great opportunity. I'd also, in case he's listening, I wanted to... Well, I don't want to call him out and say his name without his permission. I don't like doing that stuff. So maybe we'll discuss him in another environment. Maybe next time. Maybe on the next Coffee and Real Estate. All right, we're creeping up. We've just got about 7 minutes left until we get started. If you've got any questions on the front end, we are currently streaming to Facebook, which is sort of the unofficial home of Coffee and Real Estate. And then, of course, it's also up on YouTube, LinkedIn, and Twitter. My understanding is that Instagram can now be streamed to doing this. There's a lot of weird hoops to jump through to make it happen correctly. And since this was something I read about just within the last week, I didn't want, and I'd already publicized where things were going to be, I didn't want to throw something into the mix without doing some testing beforehand, because as I've learned, little changes can screw up a whole lot of stuff. So I'd rather do some tests on it before I roll it out for something that I want you all to be able to easily consume. Interesting things locally that are happening. I can't think of anything. I usually have a couple of local things that are going on in the South Valley or in the South County, but nothing's jumping to mind. In side news, I think we're creeping up on what might just turn out to be the best time to buy a car. It has been the worst time in history to buy a car over the last couple of years, and now that worm has turned. There's an awful lot of repos happening with cars. We talked about this in actually a podcast a couple of weeks back when I was sort of talking about the overall debt profile on average of people and theorizing that just like housing lending that was not so smart threw the economy into a crazy spin, Could that happen based on car lending, particularly since at the car lending level, so much more as a percentage was sort of crazily done. There are some people out there who got 160% loans on the car, right? Because remember, you don't really get a car appraised, and we all know that as soon as you drive a car off the lot, it drops in value by a certain percent. But these were people who were paying not sticker price, but sticker price plus thousands of dollars, right? And they were getting financed. They were putting down $5,000, $2,000, and just like we did with the real estate stuff, this stuff got put into securitized groups and were subprime loans for cars and were being sold on the stock exchange, and different retirement things were investing in it. All the same kind of stupid stuff that really kicked us around last time were being done in the car world. So we'll see how that goes. But the end result is nobody can get any trucks sold. Ford has tons and tons and tons of trucks. All of them are still resisting price reductions. They're stubbornly sticking to close to 100 grand for an awful lot of trucks. My guess is you're going to be able to start getting trucks for a really good deal. I have a few little things that are feelers, like Auto Trader, for instance. I kind of keep a loose track of mainstream cars there just to see how many price drops happen. And the price drops are the thing. I'm seeing there is one car that I was tracking on there that I'm actually interested in buying that has now been on the market at one of our local, there's a dealership in San Jose that's had this car on their lot now for 6 months. It's a used car, but it hasn't sold, and they've dropped the price just shy of 10 grand since they first listed it. So I think leverage on the part of buyers for a car, and particularly in the used car space, and particularly young used cars. So you don't have to go with a car that was 2010, 2011. You can go with something that's 2019, 2020, and you're going to find yourself probably a pretty good deal. All right, we're just 3 minutes away. We're almost there. And then we'll jump in. Feel free to ask any questions you might have as we go. I've got a pretty good selection of articles for us to review once we're done with our local market stuff. Not as much as last time. Last time we had almost an endless screen of stuff. This time, not so much. But some good stuff. Particularly California stuff. I mean, of course, that's where we are, right? We can talk. We've got some budget things we can talk about. We've got some immigration things we can talk about. The better word is migration. I'm not talking about like the border problem. I'm talking people in and out of the state. We can talk about the deficit. We can talk about where California finds itself and how things have changed from just a year ago relating to policies. Remember, because it wasn't that long ago, just a year ago, where on my podcast, I was talking about different plans that were being floated by the state government to provide free healthcare for everybody in California, which was going to cost something like $3 billion, billions and billions of dollars to cost to the state. And they weren't going to worry about whether you were a legal or illegal immigrant. It was simply going to be free healthcare. And man, how has that discussion changed? They now cannot even pay the bills on the things that they've committed to this year. So we can discuss some of this stuff. California is in deep trouble, and I think this pit gets a lot deeper before it gets filled back in. So we can chat about that too. And I'd love to hear your comments, what you think. But we'll float some ideas and see about discussing where we're at and why we're there. Or maybe not why we're there, but because sometimes why you get into a situation is important, because you want to remediate those things that got you there. But more frequently, the key is, where do we go from here? What do we got to do to take care of it? All right, we're less than a minute till we get started. I'm going to do a test post here to the chat. I want to make sure it's working here. All right, so I'm seeing it working there. Let me look on... Okay, there we go. All right, it looks like chat's working. I'm not seeing it as persistent for some. So the only one that is going to be persisting per se is going to be the Facebook chat. So I apologize if I miss your chat right off the bat. But I will be doing my best to keep an eye on the Facebook chat so that we see it there. But I promise you, I will do what I can to keep an eye on what's going on with the chats. It is now 10 a.m. Welcome to everyone to the Coffee and Real Estate Live Chat. This is something that I host every single month on the third Saturday of the month, where we get a chance to talk about local real estate. It is freezing cold in here. I apologize if you can hear my heater going in the background, but it's crazy cold. And with crazy PG&E rates, you're finding yourself in scenarios that are weird in terms of thinking, wow, how do I not use PG&E, and I don't know if I've turned into my grandfather or what, but I'm all about like not turning on all the major stuff in the house so that I can keep consumption down. But in any event, this is where we get together. We talk about real estate. I field your questions and feel free to share them on Facebook is the best place, but you can also do them in YouTube, LinkedIn, and on X. I don't believe I will see your questions when they're posted on X. I might, but I'm not sure. I know I've seen posts from LinkedIn. I know I've seen posts from YouTube. I've never seen posts from Twitter/X. But we'll do what we can. And I apologize ahead of time if I do happen to miss someone's post. It's not intentional, I promise. Let's see. So, interestingly, I'm not seeing. Let me just make sure here. Okay, that is correct. All right. Okay, so as we usually do, we're going to jump in here and take a look at what the numbers are for at the 10,000 foot view, right? We'll go ahead and jump into that. Let me just jump in there and get us there. All right. So as we like to do, we are going to start here with the total homes on the market. And let me get my ugly face out of the way here. There we go. All right. So this is a year-over-year comparison, and this is where we're just comparing November of 2022 to November of 2023. We've got some charts coming up here that will give us insights into what's the trends have been over the past couple of years. But right now, let's just do year-over-year, and the reason we do that is to eliminate seasonal influences, right? Because a July is very different from a December. So comparing those don't make sense. So this is why we do it this way. So this is inventory, and in Santa Clara County, inventory is down 26%. In San Jose, it's down 29%. In Morgan Hill, it's down 29%. And in Gilroy, it's down 40%. And if we think about inventory, it's basically the total number of homes buyers had to choose from in the month of November. If you're a seller, it's your competition. How many homes were you competing with out there? And of course, that number gets smaller when you start comparing folks who only want that 3-bedroom, 2-bath home. But in general, you can think of this as the competition number. And you can see that in Santa Clara County overall, we had 1,090 homes in the market versus 1,479 last year. 505 in San Jose this year versus 709 last year. 50 this year in Morgan Hill versus 70 last year. And 62 this year versus 103 last year in Gilroy. And calibrate yourself also to what was going on with interest rates. Remember, this time last year is when the interest rates had been doing their big ramp up and folks were really getting shocked by the amount they were going to have to pay to borrow their money, right? To rent money. The interest rate on renting money to buy a house. So I think the fact that we've seen things come to the point where we're selling them off a little more, it makes more sense. I think we're also likely to see this softening as interest rates go down a little bit. We can talk about that as well in November, December actually. The Fed didn't raise rates, so, and that's another thing to sort of telegraph to you. We can talk about this in a minute, but when we talk about will a recession come in 2024, I think that's one of the clues. That's one of the lines that we can read to give us an indicator that the folks in charge sure do seem to think a recession is coming. All right, so let's go ahead and move on to the next set of numbers. Let me also pull up my other data here so I've got it so I can refer to it. Next, we're talking about new listings. These are homes that were put on the market in the month of November. So these are folks who decided to jump into the market. And we can see there's more this year than last year across the board. In Santa Clara County, we had 822 homes added to the marketplace versus 709 last year. That's a 16% increase over the year. San Jose saw 423 homes added to the market versus 362 last year. That's a 17% increase. In Morgan Hill, we had 41 homes listed this year, 32 last year for a 28% increase. And Gilroy saw a 37% increase, the biggest increase, from 27 homes last year to 37 homes this year. And it's interesting to see that. We're going to sort of do a comparison when we do the month-to-month stuff. But November and December are typically low for listings and for adding listings and all that. The market sort of slows down as sellers just don't want to deal with buyers walking through their home as they're trying to entertain for the holidays. And folks just don't, and they don't want to worry about rain. They don't want to worry about these other things. So they tend to, if you're going to list your home and you're thinking about listing it in November and December, typically you're going to wait till January or February just because you tend to see the best payoff for that. That's the interest on the part of buyers tends to boost in January and February, particularly with the markets we've seen over the last couple of years. But we'll see in a minute. We'll sort of compare it month over month and see if we aren't seeing a more general increase here. All right, next, let's go take a look at the total number of homes sold. Now, one thing to extract from homes sold is also to get an idea of, are we adding homes to the market or are we subtracting homes to the market overall, right? When we can consider listings versus solds. We can see that in Santa Clara County, very little has changed, right? We talked about an increase in new listings compared to last year, but no real increase in the total number of homes sold. There's your first clue as to what the answer to that question is, as to whether or not we added homes to the inventory or subtracted them. San Jose, 4% change, 387 last year, 402 this year. Morgan Hill saw a 30% increase in the total number of homes sold, 23 last year, 30 this year. Gilroy saw a 6% decline, 31 last year, 29 this year, which is kind of interesting. Gilroy has been an interesting market because it has been, in terms of buyer attention, has been outperforming other areas as buyers look at that area as a great place to get a potential bargain in terms of amount of home you get for the dollar you spend. Now, if we go through and look at each one of these, we can see that in terms of whether or not homes were added to the market or whether we dropped the market, we can see that 778 home number for homes that were sold is not more than the total number of new listings. We had 822 new listings, so that means 44 homes overall were added to the inventory that have now accumulated because not everything we listed sold. In San Jose, that number was 21 added to the inventory. In Morgan Hill, it was 11. In Gilroy, it was 8. So every community added homes to their overall inventory. And I don't think that's, I think given the current market, I don't think that's something that's surprising. I personally think that it kind of makes sense, particularly at this time of year. What will be interesting is once we get into January and February, and particularly once we get into March, when we're going to start to see a big increase in other homes getting listed, what do buyers do? Are buyers going to come out and buy? Interest rates are obviously going to have an effect, and the communication we're getting from the folks who manipulate those rates is that they're going to freeze them and or decline them, reduce them, and I think they will reduce them since everyone's talking recession next year. The way you fight a recession is lower rates. The way you fight inflation is higher rates. So they're giving up on fighting inflation because they anticipate recession is coming, so they're preparing by dropping rates. And it's kind of a spoiler alert for future things we're going to talk about in today's show. But anyway, okay, next, let's go ahead and hit months of inventory. This represents, if we were to freeze the total inventory numbers and freeze the total number of homes that sold this month, how many months would it take to sell off that inventory? And it's all down from last year. In Santa Clara County, it was 1.4 months. If you want to know what a balanced market is, it's somewhere in the range of 4.5 to 6. Nationally, I think folks tend to go with 5.5 months, 6 months. I think here locally, 4.5 to 5 months is really the sweet spot for what a quote unquote balanced market is. And as you can see, we're nowhere near it. If somehow demand rose, and it's not unreasonable to expect that it is, we are already at a point where this would push the marketplace into even more of a seller's market. So we'll see where that goes. So Santa Clara County is down 26%, 1.4 months this year, 1.9 months last year. San Jose down 28%, 1.8 months last year, 1.3 months this year. Morgan Hill down 43%, the biggest number of the areas that we survey here. 3 months last year, 1.7 months this year. And Gilroy saw 36% decline with 3.3 months last year and 2.1 months this year. Next, we're going to go ahead and look at pending homes. Now, why do we look at pending homes? These are homes that went pending, that accepted an offer. Think of it as that. They accepted an offer in the month of November, and the status of the home changed to contingent or pending. Contingent simply means that there are things in the contract that have to be resolved before the buyer is fully committed to closing. And that even makes it sound a little bit more stressful than it is. It basically means that there is usually a loan contingency and inspection contingency so that the buyer can do any inspections or due diligence that they want to do within, it's usually a 14-day period of time to get those things done. And then once that time period passes, they sign off on those contingencies. And once it is no longer contingent, it becomes pending. And then when it's pending, typically if a buyer backs out of the deal for any non-covered reason, they'll lose their deposit. That's maybe more detail than we needed to get into here. But the bottom line is an offer was accepted, right? So this is a future indicator of what we can expect in terms of closed escrows in the next month or two. So remember we talked about sold homes a minute ago? Those weren't homes where the contract was signed in November. Those are homes where the contract was signed probably the month or 2 months before November, and escrow simply closed during that month. So it's a lagging indicator. This is a leading indicator of what's going to happen with sold homes. So, and again, this is going to be most informative when we look at the month-to-month data, not just the year-over-year data. For Santa Clara County, then the pending number is up 16%. So 639 homes went pending last year, 744 went pending this year. San Jose is a 14% increase, 349 homes last year, 397 homes this year. Morgan Hill, 25 homes last year, 32 homes this year for a 28% increase. And Gilroy saw a 44% increase from 18 homes last year to 26 homes this year. Now, this is a number I kind of pay attention to, and behind the scenes and other things I do relating to this data, get a feeling for how many transactions are failing, right? How many are not closing because of problems. And whenever you start to see interest rates go up or other weird things going on, you often see escrows that don't close. Almost always if an escrow fails to close, it's because that loan contingency we talked about fell through. The lender backed out, or which typically means that something was found in the borrower's background that made it so they wouldn't qualify for that loan anymore, or something was discovered with the property, or some funky thing. It didn't. And sadly, some of these things happen right at the end of escrow, right? When it goes to underwriting and everybody's supposed to do their final sign-offs. And I've seen things, and oftentimes it's something stupid. If you're a buyer and you go out and you buy all the furniture that you're going to want for that new home and it's going to get delivered the day after close of escrow, that's on your credit card. Well, that kind of expense can derail your loan. So don't do that. For anyone who has an agent who hasn't told them that, don't do it. Don't spend money on anything until after your escrow closes and you're in your house. Just to keep that in mind. Let's see. Let's go ahead and jump to the next thing here. From pending contingent, we go to average original list price. And I like covering original list price. I get some folks who discuss the idea that this isn't really a valuable number. I think it's a very valuable number because it looks into the psychology of sellers, people who list their home. This is what the home originally listed for, right? So when they were sitting in their living room with that real estate agent, something just weird happened with the Facebook stream, and I don't know what it is, but it just suddenly disappeared. Um, Everything is showing as correct in terms of the stream. Just the video part is not showing correctly. Well, I'm going to go ahead and assume that we're still good. In fact, let me just apologize for this, but I just want to go to the actual page. Yep, there we go. It's still there. All right, good. God. Never make the streamer panic by having incorrect things showing up on your dashboard. Anyway, so we're talking about our average original list price. The reason it's important, this is the number that was promised to folks who listed their home by the agent who listed their house. So when it was first entered into the MLS, this is the number. Now, I have gone through and corrected for any stupid stuff on this. And stupid stuff is when the real estate agent entered it into the MLS, they actually accidentally added an extra 1, or they added an extra 0, or whatever. And you would be surprised how many times that happens. So, or maybe you wouldn't. Maybe you've interacted with enough real estate agents to know that stuff. But in any event, this is the number. So this is what folks, these are the, think of this as the expectation number. And expectations in Santa Clara County were up overall by 4.5%. Last year, the average seller expected to get $1,758,243 for their home, which just is mind-numbing. And this year, it's $1,837,382. In San Jose, that number was up 4.9%. Now, also, just to kind of calibrate you, we had months of the last couple of years where this number was up 10, 20% for some of these communities. Morgan Hill had a habit of just blowing the doors off in terms of how high they expected their homes to sell for, which resulted in gigantic price reductions, like tons of homes reduced in price by big amounts of money for some periods of time there. But just bear with me. All right, so San Jose, 4.9% increase. 1,349,000 was the average last year. This year, 1,415,000. Morgan Hill. Now, I was just talking about how they tended to be so uncalibrated. Man, and every once in a while, we'll get a month where they're super calibrated. 0.5% reduction from the same time last year. Now, of course, also remember, one reason why I like Santa Clara County and San Jose numbers so much is because of the volume of data we have, the number of homes. This number can get skewed by simply 1 or 2 homes, since we have a relatively small number of homes. But this is a valid number in terms of expectations. So 1.5 million 700,000 last, 1,570,517 last year, 1,563,241 this year. Given the small sample size, I would lean into referring to this as a wash. I wouldn't call it an increase or a decrease. I think anything within 3 or 4 or 5% of last year is probably a wash. Gilroy up 11.1%. 1,133,000 last year, 1,259,000 this year. And Gilroy is still it's drawing a lot of attention from buyers. So some of the expectations on homes there could be this. It could also be that we're simply seeing 1 or 2 homes that are being listed in some of the higher end areas where homes tend to sell for multiple millions. Like, for instance, Northeast Gilroy has a lot of homes that are on several acres, and they tend to be more estates than single family residential urban homes. So I think that also tends to explain some of that. Now, if we look at average sales price, I like to look at average sales price because, well, of course, we all like to look at average sales price, right? That's a real number. That's what people on average actually paid for something. But we can also then compare that to the original list price and compare expectations versus reality. What actually happened? Here are the expectations of where sellers' heads were at, and here's what buyers actually ended up paying. So if we look at the county, we can see that the average sales price is up 6.3%. Remember, expectations were up 4.5%. From last year, 1,727,375, but that still falls below what the number was for expectations, meaning that in dollar values, the average home was originally listed for $110,000 more than it sold for. So that's how much less folks were taking. Now that represented a 6.3% increase in the same time last year. San Jose, 1,365,000 this year, 1,284,000 last year. So that's a 6.3% increase in average sales price in San Jose. but that also represents a loss from expectations. Expectations in San Jose were $1,415,000. So from expectations, that's $50,000 below what expectations were for San Jose. In Morgan Hill, we saw a 3.1% decline, and this is a big one. So last year, $1,296,435 was the average sales price. This year, $1,256,400 was the average sales price, a 3.1% decrease. But that money-wise, compared to what expectations were, was $306,000, almost $307,000 below expectations. So while sellers were coming in and expecting 1.5 million, 1.56 million, they were actually getting 1.26 million. So that was a $300,000 off amount. Gilroy, 9.8% off from last year, 1.2 million last year, 1.083 million. And this is really one of the big numbers to keep in mind for Gilroy. As shoppers for homes are seeing, and I'm seeing this in my buyers' search habits, right? I have, at any given time, I've got about 250 to 300 people searching actively for homes, meaning that they set up a search with me or on their own and are checking it regularly. And by regularly, I mean at least once a week. I have some that the number of folks who check it literally every day or check every single alert or update that comes out, that probably represents about 200 of those folks, maybe just under 190 to 200, but it's a huge number of folks. And what I've noticed is many of them started perhaps only searching in San Jose, Sunnyvale, Santa Clara, South San Jose, that sort of thing, expanded their search down to Morgan Hill over time and have now started searching in Gilroy as well. So, and I can see what homes they make comments about and what homes they like or dislike. And they're putting far more attention to homes in Gilroy than these other areas. And this is the reason. It is prices. It is what they're seeing their money can buy in these various areas. And I've had some conversations where we've discussed what are commute times, how long would it take me to get to Redwood City or downtown San Jose, what would it take me to get to Adobe or Apple or Intel or wherever. And that's what a lot of people are thinking in terms of that stuff. Next, let's go ahead and take a look at percent over or under asking price. Now, this is a chart that tells us if the asking price at the time of sale, so just like before when we were looking at original list price, we were trying to get into the psychology of sellers. This is an opportunity to get into the psychology of buyers. When buyers were faced with a list price at a certain amount, how much above or below did they offer at that price point, right? We can see there's a pretty interesting delta here on average. So if they all scored 100%, that would mean that on average, homes were selling for list price. At 99.6%, that home is selling for 0.4% below asking price, right? So that's what these percentages represent. Santa Clara County, it's up 3.7% from the same time last year. 103.3. And this is one area where, man, did I call it wrong. I did not think we would still be over 100% by the time we hit November. I thought by the time we hit September, October, we were going to see numbers around 100 or just under 100%. And mea culpa, I got that one wrong. Last year it was 99.6. This year it's 103.3. In San Jose, up also 3.7%, 102.9 this year, so 2.9% over asking price is the average. 99.2 was the average last year. Morgan Hill is up 1.3%, 97.8% last year, 99.1% this year, so still below asking price in Morgan Hill. Not by a lot, only by almost 1%, right? By 0.9%, which is nothing to sneeze at. That's still a good chunk of change. Gilroy up 1.9%, 98.5% last year, 100.4% this year. And this is an interesting point to compare to sales prices, right? We saw sales prices being the most reasonable of the areas that we check. And we can also see that the pressure of that, the new attention that's being drawn to it because of the attractive prices, the more buyers that are going to Gilroy are pushing us into a point where we're just over asking price. Now, again, because of the volume, the low volume, I would call this a wash with asking price. So in other words, on the whole, homes in Gilroy are going for asking price. Again, simply because we don't have enough data, right? We have a couple of dozen examples in Morgan Hill of homes that sell versus we got like 20, 26 homes versus hundreds of homes that we do in these other areas. So in terms of giving this any weight, I would say if you're a seller in Gilroy, if you're properly pricing your home, you're likely going to get your list price. So that's I think that's a good number for sellers there, and also another demonstration of how attractive Gilroy is to a whole lot of people. Next, let's take a look at days on market. This is how long it's taking homes to get sold, and clearly this number is going to be lower. In Santa Clara County, we can see it's down 31%. It was 29 days last year. It was 20 homes this year. In my world, as I'm looking at numbers like this, typically, if it's below 17 days, if it's below 14 to 17 days, that's an artificial number, right? Because what's happening is real estate agents are saying we will not look at any offers until such and such a date. And that date is usually 10 to 14 days, most commonly 10 days after the home gets listed. So these indicate real numbers to me. So 29 days last year, 20 days this year for a 31% drop in the county overall. San Jose, 31 last year, 20 days this year. That's a 35% drop from the same time last year. Morgan Hill, 36 days last year, 30 this year for a 17% drop. And Gilroy, 38 days last year, 26 days this year for a 32% drop. So notice how Gilroy is outperforming Morgan Hill. And it's interesting to see how things jockey back and forth. I mean, there was a period of time where Morgan Hill was outperforming cities like San Jose. And now we've sort of seen things move down to the point where we're starting to see this performance increase in places like Gilroy for the reasons we've already discussed in today's numbers. All right. I'm still seeing that this looks broken in terms of the Facebook stream, but it's according to this, it's not. Let's see here. All right, I guess I won't get stressed about it. I'm going to check it just one more time. Just because it scares me. Yeah, okay, we're still good. All right, excellent. And it's showing me what I'm seeing here, so it's not a frozen screen. Outstanding. I don't know why it's not showing me on the dashboard. Okay, so let's go ahead and jump back in here. I think this is where we start looking at past months. Yeah, Santa Clara County. And this is a good one to check out. So this gives us an opportunity to just look back over our shoulder going all the way back to June of 2021. And we'll start with total active listings. And this is the inventory number, right? So we're just looking at where it's going. And notice a completely normal drop from October to November in overall inventory numbers. If you look in October to November last year, it was a drop. October to November in 2021, it was a drop. It is very normal this type of year. In fact, you tend to see November, December being the lowest. And that's what we saw in 2021. December was the lowest. In December of 2022, lowest. And then we start to see an uptick, right? In January, February, at least we did in 2022, which was a much more normal year. We had a weird dip in February of 2023. But overall, in my head, I would normalize that line. So if we're looking at this, can you guys, yeah, you can see my cursor here. So between here and here, I'd really just connect that. I don't know what this weird little aberration was, but that's a pretty normal line. In some years, it's super steep, like this year, like in 2021. In other years, it's less so. But as a relationship from month to month, it is very normal for this to be what we see. All right. So next, we're going to go ahead and take a look at new listings and check out the big drop in new listings. So we see between October and November of last year, we had a drop. October and November of 2021, we saw a drop. It was even a bigger drop in 2021 and 2022. I think we're almost on par with a drop in overall new listings. The year to year obviously showing an improvement in the total number of listings. So that's why I think the steepness of that curve is less dramatic than previous years. because we're seeing an improvement in terms of the number of homes that are being listed. Next, if we look at homes sold, we can see a drop between October and November. If we look at October and November last year, there was a drop. October and November the year before, there was a drop. So very normal to see sales drop. That's all very normal. That's all very seasonal. There's nothing, any of the weird things that have affected the last couple of years, or COVID or interest rates or anything else. None of those things really play into it. Next, let's take a look at pendings. We can see pendings are down as well. Another thing that tends to go down between October and November of last year, down between October and November the year before. In fact, in 2021, extremely down, huge drops in homes pending. So what does this show us? If you look at the volatility or the dramatic changes in the month-to-month numbers in past years, you can see these are a little more subtle. These changes aren't as dramatic. They're softer. That tends to tell me that we're starting to see we have this low-level hum of activity, and I think a lot of it is being suppressed by interest rates. But activity is still happening, and it's happening at accelerated rates compared to last year, but the overall trend has been the same. Now, next, and again, if you have any questions about any of these as we go, feel free to ask. I'm doing my best to check both chat locations where in one area I have a grouped bunch of chats, but the Facebook chat is always off by itself. So that's the one that's always open. So feel free to ask there if you like. Now, this is Santa Clara County list price versus sales price. And you can see we had a few months, and I think we brought this up over the last several since July, where things have been relatively close. They've been staying together. And we had previous months where the list price was way out of whack compared to what homes were selling for. If you look particularly back in February of 2023, we had list prices that were way up there, creeping up on 2 million. But actual sales prices were down around 1.55 million. And then they sort of met. They decided to join one another in May, June. And we've been sort of there ever since. Now we're seeing a divergence. From October to November, we have seen average sales price drop with an average list price increase, which is interesting. And remember, this is county numbers, so this is a pretty good sample size. If we look at the same numbers between October and November, we can see that they moved together last year. And if we go back to October, November here, we can see that list price went down and sales price went up. So today, we're seeing the opposite of 2021. I mean, if you categorize it as three different possible ways, they can either stay together, or one can go up and the other can go down, or you can flip it. We've seen these last 3 years are exploring all three of those possibilities, with the most recent one being average list price going up and average sales price going down, which tends to point to a disconnect between the psychology of sellers and setting a reasonable price as they go into the market. What does that tell us? Well, if we're going to be heading into recession, it means that we will likely see an increase in reduced prices as we get into the first quarter, simply because homes are selling at lower prices and folks will have to adjust that. All right, next, let's take a look at percent of asking price over time. And this is, again, countywide numbers. We're trying to get big picture movement ideas from what's happening in the county overall. And we can see it's a steady decline. My biggest sin has been that I expected that decline to be steeper starting in say, July, August, September timeframe, to the point where by now we'd be below 100%. So I did not call it. I think I was looking for kind of what happened last year. You can see last year, as we headed into November, it was down to 99.6, and then December was 98.8. And then 99, and then things started to go back up in February. That's kind of what I expected this year, but we just didn't see it. And I think that a lot of that simply has to do with the low inventory compared to the number of buyers that are out there, keeping it up there. Because once you get to the point where you're seeing on average a 3.3% above asking price sales price on average, that tells you there's multiple offers, right? Because there's usually not a reason to go with a above asking price offer unless there are other offers in play. So that's an interesting number and definitely shows that there is more demand than there is supply. It continues to be that way. Next, let's take a look at days on market, sort of plot this out. There's really no mystery here either. It's gone up a little bit since our lowest point, which was June of 2023. up between October and November. If we look at October and November of last year, it went up. If we look at October and November of 2021, it went up. So very normal. In fact, I would say this falls stereotypically in line with past years, going way beyond the 2 years that we're looking at before this year. So no real surprises there. Next, let's talk about price reductions. So this is the percent of homes with reduced prices in November of 2023. Last month in Santa Clara County, we had 25% of the inventory in November had a price reduction. This month, it's 22%. Overall, that's a 39% drop from last year. So 39% fewer homes. The percentage drop is 39% lower than it was a year ago. In San Jose, 27% last month, 22% this month, for a 40% change from last year. And remember, this time last year, lots and lots of price reductions, just because that's the way the market was going. And we showed that in the disconnect between what expectations were and what homes were selling for in that chart a couple of pages back. In Morgan Hill, it was 20% last month, 18% this month, for a 61% drop from the same time last year. And in Gilroy, it was a 26% last year, 19% this year, or excuse me, last month, not last year, 19% this month, with a 54% drop from the same time last year. So the one good thing to see here is that all of these numbers are lower than last year or last month. Why is that good? The lower this number is, it indicates that sellers are more calibrated to the reality in their marketplaces. It actually kind of surprises me that Gilroy is higher than Morgan Hill. Morgan Hill still, in a lot of ways, is disconnected from the realities of the market with current homes on that are currently for sale. Gilroy has been historically much better calibrated to the marketplace and has had much less of a need for doing price reductions in order to get their stock sold, their stock of property sold. So that's the overall rundown on all things relating to our local markets. If you've got any questions about any of that, please feel free to reach out. I'd be happy to field any questions you might have. I'm just checking the other chat locations here to see if anybody's asked any questions. I'm not seeing anything. I promise to check these on a regular basis. The one I'm always looking at is Facebook. So if you're not watching on Facebook, you may want to give that a go if you're asking me a question and I'm not responding right away. But I promise I will do my best to keep up with folks who are asking questions. All right. Now, let's go ahead and jump into bigger picture stuff. Probably better to do it this way. There we go. So what we've got here is sort of the rundown. This isn't what we want to look at. Let's look at local market trends. Market trends explored by county, and we can see sort of, and this is giving us median list price, right? This is for the month of November. So we can see, and we can zoom in here, or excuse me, November, we can zoom in here. Where the heck? I was doing this earlier. And this is all from Tableau. But we can see right here is us in Santa Clara County. Median list price 1.4 million. Median price list price year over year is down 3.4%. And the darker the red, the higher the median list price. So, you know, and oftentimes people, because one thing we could talk about, I mean, as a chat thing, and I've got some news stories to discuss this, is where are people moving to? I mean, the folks, or where do people want to move? I've had conversations with an awful lot of people who are interested in selling their home. And for a while, Austin, or at least Texas, was really one of the top destinations. And now it's, I'm getting far more people that are doing Idaho and Arizona, but not Phoenix. They're doing northern Phoenix. So we'll see. And there's every once in a while, there's some folks who are going to the East Coast. And when I say East Coast, I mean anything east of the Mississippi, right? So that would include Tennessee, Florida, just to name off a few states that folks have mentioned to me. But still Texas, Idaho, and Arizona tend to be top ones. And I think, Colorado, I think, got mentioned once in the last few months for folks that I've talked to. But this sort of just gives us an idea of where we're sitting. We're still way high. And the reason why I brought that up is some people say, well, you know, Robert, I want to stay in the state, or I don't want to go too far from my family, but I don't want to spend tons of money. Well, great. Then go up to Glen, California, where it's $384,000 is the median price. Or go to Lake, California, where it's $399,000, or 265 up in Modoc, or Alpine where it's 277, or Tuolumne. You know, there are areas that aren't that far away where you can live in a home at a reasonable price, where you can sell your $1.4 million Santa Clara County home and move over to Merced and spend $434,000, right? If you're an investor, there are some great places all through the Central Valley that you can go and get yourself a great investment property, if proximity is important to you. So just something to keep in mind as we go through this. Let's see, list price trends. If we just focus on Santa Clara County, we can see big drop off, right? The most recent is November, 3.4% year over year drop, active listings over 1,000. They may be tracking a slightly different number than I am. When I do my numbers, I'm tracking residential only, and I'm only doing single family residential and townhomes and condos. They may be doing a broader number or a more narrow number, but you can see the trend here. The trend is down, and I think that's one reason why we're seeing the prices we're seeing and the over asking price offers is simply because the demand is outstretching the total number of homes available. We already did the list price heat map, prices year over year heat map. Median list price year over year change. We can see we've actually got a decrease of 3%. Days on market heat map. Look at that. We're one of the darkest here at 34 days, 80 days though, taking a lot longer. And if you find a good price and days on market mix, and you're likely to be able to make a really good offer on something and get yourself a good deal. Days on market trend. Santa Clara County again up. Just all of them are up, right? Everybody's virtually up here. But let's go ahead and take broader looks in terms of what the hottest markets are. And these are their rankings, right? So this would be the top 10. Notice not a single California home or California community is listed here. Let's see here. Manchester is the hottest. There's not even anything on the West Coast. Let's see here. And then in terms of cool, again, most of this is focused on the East Coast. In terms of cross-market demand, that's not a very interesting one. National market trends. The active listing count nationally is up 1%. Active listing count is 754,000. So overall, it's up. For us, it was down. Total listing count, down a little bit, over 1.1 million, with each of the trends here. Look at the total listing count, down, and then close to no change here at just 1%, with big increases obviously in the summer months. Pending list count, median listing, median days on market, new listings, price reduced share. There we go. That was one I was looking at that I thought might be interesting. Price reduced shares 18% overall. It's down a little bit from last month, but only by 1%. So relatively high, but we can see definitely an increase in the number of homes nationally that are seeing a price reduction. So it's not just us. We are obviously still seeing more of it, but we've also got more elbow room in terms of the prices that we've been asking. In terms of affordability, the less red is more affordable. And we can see a lot of these areas, but it really doesn't tend to get to the lighter colors till we get to this side of the Mississippi. So I'm not someone who tends to gravitate to that. I'd be fine with something. And I've also, what's another interesting area is Utah that I've had some people ask about. I've had Idaho people who are looking to leave California and go to Idaho, both for Boise and Coeur d'Alene. And then, of course, there's Texas. All right. Other interesting news we can chat about. Federal Reserve holds rates steady at 5.25 to 5.5, acknowledging recent progress. This was just sort of a headline blurb that I thought would be good to share with you. This indicates, what does this indicate? What can we read from this? As we see them slow down, and then if we see them pause here at this current rate, by this time next year, you can expect that they've reduced this rate. Why? Because all indicators are that everybody who's in charge has bought into the idea that we're heading into a recession in 2024. So to fight that recession, they are going to reduce rates, because that's what you do for a recession, right? We've been fighting inflation by raising interest rates. So if we're doing this, the odds are we're going to see more reductions. Fannie Mae expects home sales to bottom out. Here's the latest forecast says. Why is the most likely economic trajectory for what is it? Experts at Fannie Mae point out that the high GDP as of the third quarter of 2023, a very healthy 4.9, is built on shaky foundations. Fannie Mae is predicting a recession in the latest economic developments report. As a result, home sales are expected to bottom out next year before ultimately improving in 2025. Let's see. Real incomes grew. All these. I don't know why my highlighter isn't working. I highlighted all of this stuff earlier, and suddenly it's not working. All of these. Yeah, I remember doing this. I wonder why they disappeared. Anyway, all of these factors point to a situation where the current spending levels propping up the economy are unsustainable. Fannie Mae predicts that consumer spending will go down in 2024, reinstating a more normal relationship between spending and income. I think this is a super interesting point to make, primarily because consumer spending has been ridiculous with the money that was kind of being given out with the COVID stuff that stopped, which was feeding this buying of cars. What we saw was just crazy, unhinged consumer purchasing, right? So this is assuming that we break that habit in 2024 and start returning to things a little bit more normal. Fannie Mae thinks GDP will decline 0.4% on a Q4 basis in 2024, although the negative figure is expected to result from the timing of the year-end report in the fourth quarter. It's not indicative of a deeper economic downturn. What a bummer. I highlighted so many little things here. Again, these are not alarming figures, which is good news for the economy in the long term. However, it's not such good news for the housing market. Paradoxically, these unemployment levels aren't quite high enough to make an immediate difference to interest rates. Given the unemployment rate is still below 4, a premature easing of monetary policy would risk reanimating inflation, so we do not expect the Federal Reserve to be quick in cutting rates in coming months. So I don't think that's wrong if we're just talking about coming months. But let's talk about the year. This fact that they have stopped raising interest rates indicates they are now in a pause mode to look for more data as it relates to recession. But I tell you what, the minute they have a hint that recession is actually coming, those interest rates will get dropped. And it seems like all the institutions are now on the a recession is coming bandwagon for 2024. Needless to say, sustained high Fed rates translate into high mortgage rates that are hampering home sales. Kinda, yeah, but not directly, right? Remember, it's the 10-year Treasury note that is what is going to influence your mortgage rate the most. Fannie Mae Economic and Strategic Research Group expects things to get worse before they get better. Home sales will bottom out in early 2024 per the ESR report. The silver lining here is supposed to be interest rates will begin coming down in the second half of 2024. Wouldn't surprise me if it actually happens a little earlier. So by their comment is it'll happen after July. I wouldn't be surprised if it's May. Because I think that, yeah, we're going to go into a recession, and I think the strength of the recession will become far more obvious by then than folks like. So that's interesting. I mean, Fannie Mae is no slouch, right? It's a government-sponsored entity. Let's see here. So let's go ahead and go to the next one. You know, I need to take a really quick break, so I will be right back. Stay with me. Don't go anywhere. All right, here we go. Back in the saddle. Apologies for that. Okay, let's go ahead and jump into the next topic here, which is 8 point, and this is more California specific, really, or we're going to get into more California specific stuff. But 8.2 million people moved in 2022, and these are the destinations that did the best. And I thought this was interesting to note because there's a lot of things going on with California that I think are worth you being aware of. We're going to talk about the huge deficit, how much things have changed in just the last year in California. Businesses are moving out of California at record numbers. We have now broken 2 records in the state of California that have never happened before. We're going to talk about those in a minute. So this is state in-migration rates compared to national state-to-state migration. So compared to the national, and remember, when it comes to in-migration, California, in terms of just population growth at all, is the lowest state, the least moved to state. We can see that compared to the national average, lower, right? Look at all these other states. And this is for 2022. Amazes me that Texas is lower. But it's still better than California by a long shot. Next, what states and areas are people leaving? State out-migration rates compared to national state-to-state migration rates of 2022. Lower. That's for 2022. Now, I did a podcast on this subject in July, I think, where we talked numbers. And we have lost like 500,000 people since these numbers. So these are optimistic. These are bright, shiny numbers compared to what the reality is now. Texas, which saw the least amount of people leave the state, the real estate market is in correction. And I wanted to call this one out because if you're someone who's looking to invest, I still think Texas is a great place to potentially invest. I'm torn as to whether or not I'd want to live there. I've been to Texas quite a few times, particularly Austin, Round Rock, Lake Travis, which is directly west of Austin, would be kind of like my go-to area. But it's just so freaking hot. But Round Rock, I think, is still an excellent potential investment, particularly today. Now, one of the ones where I called Austin and Round Rock as great places to invest before they blew up. So this is going back quite a few years. But now things have started to decline a little bit, and I do not think that's a long-term trend. I think the current decline in the Austin market is a relatively temporary thing. And if you're looking at someone who likes to buy at the bottom of a market, I think keeping your eye on Austin and Round Rock in Texas is probably a good bet. Just to suggest, I'm keeping an eye on it, so I'm not just saying you should do it. I'm actually looking at it myself. Next, and we get into some California stuff here. So this is from Politico, so I get that there's a take on stuff with certain outlets, and I try to focus just on the actual data from these and try to tease out the opinion and focus just on the facts. California's budget deficit has swelled to a record $68 billion. Now, the last time I did a podcast on this, it was like at $54 billion. It's at $68 billion after months of unexpectedly low tax revenues. Why low tax revenues? Fewer people, right? And here's the thing. You are disproportionately losing citizens who make higher incomes, right? Higher incomes tend to facilitate an ability for more mobility, but also you tend to feel the pinch more in those scenarios. So, and this isn't my opinion. When I've gone out and looked at the data, it is folks in a higher pay bracket, a higher tax bracket that are tending to move. A shortfall that could prompt the state's deepest spending cuts since the Great Recession. And the reason why I highlighted that was because the assumption here is that somebody somewhere in California state government is creating a prioritized list, right? Where hopefully the top 10 items are the core competencies that we should expect from a state government. And sadly, I don't think that's the thing. I think there's an awful lot of weird political stuff that goes on deciding who gets the money. But the bottom line is California's state government needs to trim huge. In fact, there are an awful lot of organizations that I think don't just need to be cut in size, but cut completely. But we'll see how that goes. I'm not optimistic, given the folks in charge. And there's a reason why I'm saying that, because ultimately we want to talk about where the greatest sting gets felt. Because if you believe that the greatest sting is going to come from the state government cutting on itself, I don't think you've been in California very long. So we'll chat about that a little bit. Again, still looking at the comments. If anybody's got a question or something they'd like to share, feel free to do that. The latest deficit figure calculated by the nonpartisan legislative analyst's office and released Thursday far exceeds the $14.3 billion estimate from June. And we've talked about this a bunch. This comment blows me away. The state remains in a good cash position, and that really wasn't the case back at the start of the Great Recession. Very true. So that's why they would stop short of describing it as a crisis. I tell you what, if any state owes $68 billion or has a shortfall of $68 billion, if you don't categorize that as a crisis, you don't know how money works. So I realize that some folks, I'm sure this legislative analyst, Gabriel Patek, has some sort of vested interest in being a good little supporter of the state legislature, but to categorize this as not a crisis, I think is less than honest. So what else? I had more in here. Yes, tax filing deadlines across most of California were delayed from April until last month, leaving the analysts in the dark about how much revenue was available. After seeing cash receipts, they forecasted that revenue would fall $58 billion short of previous expectations, fueling the massive deficit. Let's see. Is there more? No. Okay. Newsom's Department of Finance earlier this year warned California would continue to face a revenue downturn due to stock market. How did I not highlight this? Due to stock market declines, interest rate hikes, and inflation. No, you are not seeing a $58 billion shortfall because of stock market declines, interest rate hikes, and inflation. You're seeing it because all the people who make money and contributed to the tax base are leaving. I was born in here. I was born in California. I was born in San Francisco. I've lived here my whole life with a couple of, relatively, given the lifespan I have so far, I spent a couple of years living in England. I spent a little time in Florida. I have a business that is absolutely tied to California, right? A real estate license is state to state. And my exit strategy includes leaving the state. I think a lot of craziness is on the horizon, and we're going to talk. And that statement isn't just a random one. I know I usually walk off into the tall grass conversationally sometimes, but this all does relate. So we'll get to that in a second. Next, California faces astounding budget deficit as residents flee to red states. Again, who's this from? So this is from MSN. So we had, I think, Politico. I don't know if Politico leans right or left, but this is MSN is clearly one that tends to read more liberal, I guess. California's grappling with significant budget crisis, $68 billion. What was the number we just threw around? Was it 68 or 58? No, 68. All right. I think it was 54 the last time I looked. The state is experiencing an exodus of people and businesses to Republican-run states. I love that and this link does not take you to anything discussing the exodus of people. So I don't know why that's created an automatic link there, which has further exacerbated the financial strain. And I also love that they don't mention that one reason is because the people who are leaving, they tend to be big businesses. And here's the other thing. In many of these articles, they'll say, well, you know what? For every one business that leaves California, 2 or 3 are created. Sure. But those aren't a Tesla, right? Those aren't a company with hundreds of employees. These are the average. Typically, a company that gets started in California has 1 or 2 employees. I have a company that was started in California. It currently has 1 employee, and that's me. So it changes every once in a while. I've been as high as 8, and I've been as low as me. But the fact that you think that is equivalent somehow in your mind, that a one-person corporation is contributing as much to California in terms of taxes as a multinational or a very large corporation with thousands or hundreds of employees, somebody needs to get better connected with reality on those. The report also suggests the state must consider increasing revenue. So let's understand what that means. The state is not a business. How does a state increase revenue? And this is where we're going. with all of this. With my little allusion to stupid stuff around the corner, it is all summed up in that 2 words: increasing revenue. How does a state increase revenue? Now, ideally, now that's, revenue is what comes in, right? So what comes in is taxes. That's us. But there's 2 ways to handle this. There is increasing revenue or reducing expenses. And their next thing they say is cutting spending. The bottom line is you cannot increase revenue. The reason you are losing so many people is because you keep increasing your revenue, which means you keep taxing us more and more. I love the gas thing. The gas thing is a good example. Now, I happen to follow the governor's office on Twitter, and they want to talk about how big oil is gouging everybody. Well, if big oil is gouging everybody, how is gas $5 cheaper in neighboring states? They're not gouging anybody. Or maybe they are. Maybe in some cases they are. But if you want to look at what contributes to the cost of a gallon of gas in California, it's not what the oil companies are charging. It's what the state is charging. So, I mean, you can Google that anytime. I mean, obviously, we have the highest gas prices. Our gas prices are higher than Hawaii. Every drop of gas that goes to Hawaii, a special boat has to go to Hawaii to unload it. Here, if gas needs to get to California, I mean, the refineries are like in Texas and other places. It's just got to go on a truck or a railroad car. You got to get a boat to get stuff to Hawaii. So clearly there is a disconnect here in the reality. I'd love to see some responsible assessment of what they charge. And California has a history of doing really stupid stuff to their gas in terms of additives that they've put into the gas. There was one in the 90s where everybody ahead of time was saying this stuff's going to cause cancer, and the state was like, nope, it's all totally safe. And then sure enough, everyone discovers it causes cancer. Anyway. Additionally, the state experienced its first ever population decline in 2020 due to COVID-19 lockdowns. My understanding is that's not actually correct. I've been talking about population and what's going on in California for a long time, and I seem to recall having discussions about declines in immigration into California long before 2020. Federal delays in tax collation forced California to pass a budget based on projections instead of actual tax receipts. Let's see, that's not the one. Now, sort of contributing, right? Several things are happening with our, and I think do I have an article? Do I have an article? There we go. Yes, I do have an article on that one. I was wondering. All right, so let's talk about San Francisco for a second. San Francisco vacancy rate is at 35%. Now, when I first heard this number, I thought it was wrong. I thought it had to be wrong. Because in my entire life, now I've never done a ton of business in San Francisco. Despite having been born there, I am not the biggest fan of San Francisco. And I am absolutely not a fan of San Francisco as it exists now. Back when I was in college and then in the 90s, I, on a pretty regular basis, would go to San Francisco for a variety of things, whether it was theater or it was hanging out or checking out, doing stuff at the ocean. So San Francisco had its draw. It had its locations. I've had to go up to San Francisco a few times over the last few years, and it is a third world country in San Francisco. The last time I was there was for a wedding, and it looked great. But why did it look great? That was 2 days before what was the big political thing where they actually cleaned up the streets? Because I was stunned, because the last time I had been there, which was about 6 months earlier, it looked horrible. And I was going down the exact same streets and it looked fine. So, and that's all back to horrible again now, I'm told. I haven't been there since the wedding I went to, which was 2 or 3 weeks ago. But anyway. So yeah, this is a real number. Vacancy rate of 35%. That's the highest on record ever in the history of the city. And it's expected to go higher, and it will go higher. And why will it go higher? For the reasons we just discussed. Nobody wants to go to Hawaii. Nobody wants to go to Hawaii. Nobody wants to go to San Francisco. Businesses don't want to be there. Employees don't want to have to commute there. And think about what that equals, right? Think about all the money that the city takes in based on people being forced to go into that city to go to work. And now that's all going to go away. And the number of people who now want to leave the Bay Area is over 50%. And if I was polled today, are you considering leaving California? I would say yes. Now, in the state overall, it's well over a third. If you talk to, if when you see these things that do research on what are your intentions for migration, et cetera, over 33%, over a third say they want to leave the state. If you talk to people just in like in Silicon Valley, in the Bay Area, the San Francisco Bay Area, it's over 50%. And that's been steadily increasing. And I've done tons of podcasts in the past. Each year it comes out where it's a higher number. I remember the first time we talked about it being 25%. I remember way back in the early 90s, it was like in the teens. And now it's half the population of the area. So California's population may be declining, but its budget deficit keeps growing, as if one offsets the other, right? This was the big one, because these are two things that I was talking about before that have never happened, aside from that whole 35% vacancy rate in San Francisco. And remember, that's going to feed a residential vacancy rate, right? As commercial properties dry up, the need for people to live in the city for their job dries up with it. So that means fewer and fewer people needing to live there. I'm going to do a quick comment check here and see if anybody's asked anything. All right. Feel free to ask any questions in the comments. I'm ready to field anything you might want to ask. But here's something that I think is very interesting, because this is two things that have never happened in California history before. California lost some 500,000 people to other states from April 2020 to July of 2022. So remember, this data is a year and a half old. Do you think the in-migration of people to California has improved since July of 2022 or gotten worse? Spoiler alert, it's gotten worse. So that $500,000 person number is much higher now. A total of 138,000 people left in 2022. The declining population can and will also lead to California's political power on the national stage diminishing. In 2010, California failed to gain a House seat. So that's why I keep trying to tell you that this whole people being in or out of California thing has been around a lot longer than since COVID. First of all, we didn't get an additional seat in 2010, gain a House seat or an electoral college vote for the first time in the state's history. That's the first time that ever happened, where we didn't get an additional seat. In 2020, we lost a seat for the first time. Okay. And remember, if you lost it in 2020, that's based on data that predates COVID. So don't tell me that stuff's from COVID. Sorry. The math doesn't work. And the projection is that they're going to lose 5 more in the next 6 years. Between now and 2030, that they'll lose 5 more. Wouldn't surprise me at all. And it wouldn't surprise me if that estimate is low. The trends we're seeing are very clear, and the solutions just don't seem to be something that the state government is willing to pounce on. Newsom and California Democrats are responsible for that, and this is from the Washington Examiner, and their tone sounds politically kind of biased. And for why such states as DeSantis' Florida or Texas are more popular destinations for people fleeing damaging blue state policies. Newsom couldn't defend his record in California because, okay, this was talking about the debate between DeSantis and Newsom, where Newsom tended to focus on national stuff rather than how he ran his own state, which seemed a little odd to me. But okay, that's it. Those are the things, right? Oh wow, and it's already after 11. Wow, so it took me as long to cover all that stuff as it did to cover all the ones. I must have really zipped through the ones last time. So that kind of covers it. That's the big ticket items, I think, for this month. So predictions. Do we want to go with predictions? If any of you have predictions, share them with me in chat. I'll be happy to discuss them. But recession's coming. I've thought so for a while. I actually I think that sort of recessions have been looming for a long time. This has been on a slow burn for quite a while. And in terms of the popular estimate that we will see interest rates decline in the second half of 2024, I actually think it'll come a little earlier, a couple of months, 2 or 3 months before July, not after. Not the second half of the year, but in the first half of the year. And I think it's because we'll simply see those recessionary influences getting stronger rather than subsiding. And just as we've talked about hundreds of times in the past, when you're fighting inflation, you raise interest rates. When you fight recession, you lower interest rates. And now we seem to be at that tipping point where the folks in charge of the money are leaning more into the idea that recession is now a bigger threat than inflation. So we need to stop doing the things designed to reduce inflation and start focusing on the stuff designed to soften a recession. To me, that equals dropping interest rates sooner rather than later. But right now, they're taking a cautious stance. But it wouldn't surprise me if in the first quarter of next year, we actually see a drop in the prime rate. So I don't know if you heard it here first, but you're hearing it here from me now. All right, so that's about it. If there's anything else we want to cover, we can see that in the last week, we've had 4 new listings. 1 price increase, but no price decreases. And this is just over the last 7 days. And I believe this is just Morgan Hill. Contingent, 3 homes went contingent, 9 went pending, 8 sold. So no unusual performance here in terms of that stuff goes. But yeah, we've kind of covered already the local markets. All right. Well, I really appreciate you spending your valuable time with me. The goal is always to leave you with more knowledge on the table than I take up in your time. If I can help you with any of your real estate goals, feel free to reach out to me. My name is Robert Whitelaw, licensed real estate broker right here in Santa Clara County. If you'd like to find out more about the value of your home or you'd like to start your home search, feel free to go to soldbyrobert.com, where I will be happy to help you move forward with your real estate goals, whether it's buying, selling, or investing. All right, thanks again for checking in with me today, folks. I hope you enjoy the rest of your weekend. I will see you guys next month for the next Coffee and Real Estate.